Hey everybody, hope you're all doing well. In today's video, we're going to be talking about choosing the best POI. So this is going to be a very, very important video. I want you all to pay very close attention and take notes if you have to. Feel free to rewatch it as many times as you like. I really want these points to be nailed down in your trading psychology because this is going to really help you find the best trades overall and have a higher win rate. So without further ado, let's dive right into it. As you can see in front of me, I have a few notes written down here. We're going to briefly go over these notes here, these 5 steps in front of me, and then we're going to go over multiple chart examples, okay? So in today's video, the way I want to drill down these points is by going over 2 risk entry examples, as well as 2 confirmation entry examples, because all of these 5 steps actually tie into both entry types, okay? So they're not different. We can utilize these same 5 steps for both styles of entries. Okay, so let's dive in. Number 1 is pretty straightforward. To choose the best POI, the first step is locate the break of structure. We all know this, okay? We've all watched the video content. We know that this is the first step. You have to locate the break of structure. And in brackets here, I just wrote a clear break of structure with candle bodies, not wicks, okay? So that's very important because when we see wicks breaking structure, that's a very weak sign in price action. We want to see full candle bodies breaking structure because that signifies true momentum in the market. All right, pretty straightforward. Now, number 2, gauge premium versus discount pricing. We already went over this in previous lessons. So as you'll notice, a lot of these points here are just a culmination of the previous things that have been taught. This is basically putting it all together to locate the best point of interest to trade from, okay? So again, gauge premium versus discount pricing. And in brackets, I've written buy below the 50%, sell above the 50%. Okay, if you've watched that video on premium and discount pricing, this should be pretty straightforward. Now, number 3, locate the point of origin for the break of structure. We all know to do that as well, but it helps to do these in order, okay? That's very important to mention. It helps to do all of these steps in order. So you gauge the premium versus discount pricing first, and then locate the point of origin, because by gauging premium and discount pricing, it helps eliminate a lot of unnecessary points of interest. All right, so again, locate the point of origin for the break of structure. And in brackets, I've written the extreme or the zone that created impulsive imbalance. So we're going to go over that more in the actual trade examples in a moment. But for now, just briefly going over the points, okay? So the extreme is the absolute lowest or highest point, depending on if you're buying or selling, that you could possibly trade from before the trade idea is invalidated, okay? So that's the extreme. And then, or the zone that creates impulsive imbalance. So it doesn't need to be the extreme, but when we see an impulsive imbalance created in the market, that gives validity to our point of interest. So again, it doesn't always have to be the extreme, but the extreme is the safest. Number 4, identify resting liquidity around the point of interest. Now this comes in the form of many retail patterns such as double tops and double bottoms, trend lines, etc., flags, head and shoulders, things like that. So those are the common retail patterns where most retail traders are placing their stop losses around. So that is an area of liquidity that the market will most likely purge. So if we're aware of that, then it works in our favor. Okay, so again, we'll go over this in the trading examples. Now, number 5, the final step here, do not over refine the point of interest, right? The goal is to find a winning trade, not to have the tightest stop loss possible. All right, trading isn't about ego. I know sometimes if you go onto Instagram or YouTube, you see traders bragging about 1 pip stop losses, 1 to 100 trades because of their 1 pip stop loss. Like, it's completely unnecessary. We're not doing this for ego. We're doing this to be profitable, to make money. That's why we're all here, right? That's the whole point of trading. So do not over refine the POI down to like a 15-second POI where you can achieve a 0.6 stop loss. It's completely unnecessary. So these are the 5 steps that I've written here on my chart. And now that we've gone over those basic steps, what I'm gonna do is, this is an anchor text. So I'm just gonna move it up to the top left corner of my chart, and it will stay there as we move around and look at the chart examples, so we can always go back to these steps, all right? So now that that's over with, let's dive into some chart examples. All right, so to start our chart examples today, we're going to be looking at the Australian dollar versus US dollar, and we're currently on the 15-minute time frame. Now, before me, I have an example of clear bullish order flow, so we're of course looking for buys. Now, in recent price action, we can see that we have a solidified high right here, a solidified low right here, and then clearly price has broken that structure. So step number one, of course, locate the break of structure. So let's map that out. First of all, we have a minor break of structure here. It's important to note, but the actual break of structure is right here. So let me just map that onto the chart. All right, so the next step here, before we go any further with the breaks of structure, the next step on the list is to gauge premium versus discount pricing. Now, in previous lessons, I've told you could either use the Gann box tool or the Fibonacci tool. For the purpose of this video, let's just use the Fibonacci tool. So I'm going to drag from here to here. Now you might be wondering why I did that, because I said this was the solidified low. This was consolidation here. This was the actual bullish leg. So although this is our recent higher low, right, this is a new low, but it's not necessarily a higher low because this didn't break any structure. So we've dragged the Fibonacci tool. We can clearly see, buy below 50%, sell above 50%, right? We're only looking for buys here. So right off the bat, we can eliminate anything that was within this area. Now let me briefly explain why that's so important, okay? Let me delete this for a second. A lot of people might have looked at this chart example and said, well, this right here is a great point of interest to trade from, okay? Because you've watched the other videos on imbalance and you recognize that there's significant imbalance here that was created by this impulsive bullish candle. So you may be thinking this point of interest right here is the best, most recent one to trade from. However, again, just by using this simple concept, of premium versus discount pricing, we can clearly see that that is a very low probability area to be trading from because it's above the 50% mark of our Fibonacci tool here. So that would mean that we'd be buying in premium pricing, which we of course don't want to do. We want to buy low and sell high, right? We've all heard that phrase before. So in order to do that, we disregard everything up here and we only focus on everything down here. So with that being said, what do we have down here? Well, there was a minor break of structure and then eventually a full break of structure, right? We've already eliminated this point of interest and everything within here is pretty efficient pricing, okay? You can see that they're very small, low volume candles. All the wicks are meeting. We don't have any imbalance or inefficiency within this area of price action. So we can kind of disregard that as well. There's no clear area to enter from. Of course, on lower time frames, there would be more of a story to be told within the wicks. But like I said, overall, this is very efficient pricing. So we're just going to ignore that. Now in this video, I'm not going over multi-time frame analysis. I'm not dropping to the 1 minute or the 3 minute or anything like that. This video is just on choosing the best points of interest, which can be done on any time frame for any style of trader, okay? So with that being said, with this being all efficient pricing and not having a clear point of interest, that only leaves one area down here, okay? So this would be the extreme actually. When I wrote locate the point of origin for the break of structure, the extreme or the zone that created impulsive imbalance. So technically, this zone here created impulsive imbalance, but we already eliminated that zone due to the premium versus discount pricing model. Okay, so now we can target the extreme, which is way down here. This is the last point in price before our trade idea would be invalidated, right? Because if price were to break through that low, then that would change market structure. We would no longer be looking for a buy position, we would be looking for a sell position. So this point is our extreme, and it also created impulsive imbalance. We have imbalance right here, okay? So we can clearly see momentum kicked in from that point. Now, let me delete the premium versus discount pricing, the Fibonacci. There's two ways to look at this point of interest, right? If you want to be safer and more general about it, you can target the bearish candle, right? You can target that whole thing right there. That to me is a little too large. If we measure how much our stop loss would have to be, it would be around 10 pips. It's acceptable, but doesn't really fit within my parameters. So what I would do is refine it down to this candle, this low volume candle. I would still place my stop loss below this wick, but being able to enter from here would make a huge difference. Now, another thing you can do if you're not good at refining the stop loss, or sorry, refining your POI like that, you could still, let me delete this. You could still target that bearish candle, but enter off the 50%. And that kind of achieves the same thing overall. So if you're having a hard time refining your point of interest, simply keep it general by targeting the last down candle before the up move, which is the order block. But use your Fibonacci tool or the Gann box tool to find the 50% and enter off that, because then from 10 pips as a stop loss, you could now achieve about 6 pips, which is very healthy. I'd be comfortable with that. Okay, so, but for the purpose of this example, I'm going to do what I would do, which is target this candle right here. Let's just drag that out, and I'm going to label it 15-minute just so everything stays nice and clean. We know what time frame we located this point of interest on. So we've taken care of step 1, 2, and 3. Now step 4, identify resting liquidity around the point of interest. So we actually do have quite a bit of resting liquidity around the point of interest, and it may not be visible right away, but it's actually in the form of trend line liquidity right here. If we were to drop to the 5-minute time frame, for example, this would be much more easily identifiable. We have this right here. It is not equal lows, a double bottom, but it is relative equal lows. So we can label that. Go back to the 15-minute time frame. So this adds more validity to us targeting this point of interest, right? Because we know there's resting liquidity here, and price is most likely to purge that before triggering our point of interest and then hopefully taking off in our favor, okay? Now step number 5, of course, do not over refine the POI. I did not. We're on the 15-minute time frame, so this is certainly not over refined. It's basically just 50% of this bearish order block here. I just simply refined it to this candle, but it's not over refined. Over refining would be going to the 1-minute time frame or the 30-second or 15-second time frame and really getting the point of interest refined down to like 1 pip or half a pip as a stop loss. And that is a bit excessive in my opinion. So we've already covered that, all right? So now that we've gone through all 5 steps of choosing the best POI, let's play price forward and see what we can see here. Okay, that went pretty quick. As you can see, we did not trigger the point of interest just yet. Let me place a position tool here though, because I didn't do that yet. So what can we get away with here? We can get away with a 6 pip stop loss, and we're simply going to target the most recent structural swing high. That would give us 7.77 as the risk to reward. Okay, so 6 pip stop loss, 46.6 pip take profit. Now, like I said, this was not triggered. We came down significantly, but it didn't tap into our POI. Now, of course, if you were targeting this order block altogether, you certainly would have been tapped in. But for me personally, the size that stop loss would have to be would be too much for me. I don't like to have a 10 pip stop loss or more, unless I'm really swing trading on a higher time frame, which I don't do quite often. So we're going to disregard that. Now here's the thing, if we miss this opportunity, it is what it is. Okay, so oftentimes you will miss opportunities. That doesn't mean you were wrong. It just means the trade didn't fit your guidelines, and that's totally fine. So although we tapped into this order block, the trade wouldn't have met my guidelines. The stop loss would have been too big for my trading plan. So if I missed this trade, that would have been completely fine with me. Let's play price forward though and see if we eventually do get tapped into this trade. Keep in mind, this is a risk entry. We're going over a couple of risk entry trades first. And then afterwards, we will go over the exact same 5 steps for the confirmation entry model. So we certainly haven't been tapped in yet. Let's see if we get tapped in. Okay, right there. So as you can see, it's really all about patience. There was still imbalance between this area here, where the wick came down here, and our point of interest here. There was imbalance that was created by this impulsive candle. So it would make sense for price to eventually mitigate that area. Now the key word there was eventually. It does not have to happen right away. You have to be very patient for these things. And that's why setting limit orders can be very advantageous, because you don't need to monitor price all the time. You can just wait and get a notification once it gets triggered. So now that we're triggered into this trade, let's see how it develops. Okay, so significant profit right off the bat. Not much consolidation. Of course, on lower time frames, these wicks would represent a lot more, but we're staying on the 15-minute time frame for the purpose of this trade. Are we going to? Yep, we get taken out for full take profit at 7.77R. So as you can see, that's a beautiful textbook trade based on this 15-minute point of interest. And this point of interest was located, this point of interest was located using these exact steps. So if you're struggling to find the best point of interest, please rewatch this example and utilize these 5 steps in your own trading. Apply these to your charts and you'll see a huge difference with your win rate and overall clarity in the market. So let's move on to the next example. Okay, everybody, so we've got another example to go over as a risk entry, and we're currently on GBP JPY on the 1 hour time frame. So in front of me, we have what was bullish order flow, but we've recently seen a clear break of market structure to the downside. So in this scenario, we're only going to be looking for selling opportunities. So this already takes care of the first step of choosing the best POI, locate the break of structure. Keep in mind a clear break of structure with candle bodies, not wicks. Okay, so we do have full bearish candle bodies here, clearly breaking this structural low. So what was bullish order flow is now turning into bearish order flow. So we're going to be looking for a pullback and then an entry for bearish continuation. Okay. So step number 2 in this scenario, let's gauge premium versus discount pricing. And that means buying below the 50% and selling above the 50%. So of course, if we're looking for a sell position, we're going to drag our Fibonacci or Ganbox tool from this high to this low or vice versa. And we're looking for selling anywhere in premium pricing. Okay, so in this area here, above the 50% is where we're looking for. So right off the bat, that eliminates this POI, okay? Because some might say, well, this is the decisional order block, the decisional, refined supply zone that caused the break of structure. Sure, it is closest to the break of structure that occurred, so I understand why some might think that's valid. It was the last point of low momentum prior to the structural break. That is completely correct, but just by gauging premium versus discount pricing, we can eliminate it as a potential point of interest because we know that this point of interest is within discount pricing, which makes it a not very probable place to trade from. So with that being said, we now have what I would say is 2 points of interest to focus on. We have one right here, which is the extreme. And we also have another one right here. So let me delete the Fibonacci tool and we'll go over each of these in detail, okay? So first I want to go over this one right here. This is the extreme, okay? So step number 3, locate the point of origin for the break of structure, the extreme or the zone that created impulsive imbalance. So this is for sure the extreme. It's the absolute last point in price before the trade idea would be invalidated. So if price went like this and surpassed it, well then we'd be continuing the bullish order flow because this is the recent highest high. And if that gets broken, we would be looking for bullish continuation instead. So this is the last point in price where our trade idea would be valid. So that is the extreme. Now, In terms of imbalance, we don't actually have any imbalance really in either of these zones. And that's okay. I mean, it is preferred to see imbalance. That adds validity to the point of interest, but it's not 100% necessary. So I always prioritize market structure over imbalance. Imbalance, like I said, it's a nice confluence to have, but it's not absolutely necessary. Paying attention to market structure, we see that we do have a clear break of structure here, which means we know there's going to be a pullback and a continuation. Excuse me. So with that being said, there is still a trading opportunity here. We don't need to identify imbalance. It just helps if there is some. But like I said, in this area, I'm trying to look closely here. There's really no imbalance. All the wicks are meeting each other. No imbalance here. Really no imbalance there. So it's all pretty efficient price action. However, there is still a trading opportunity. So instead of looking for imbalance, I'm going to be more concerned about market structure. So this might be more visible on the 15-minute time frame. Let's drop down. There we go. So as you can see, the extreme point of interest up here, it did create some bearish momentum, but it didn't actually break any sort of minor structure. Of course, we do have the overall break of structure here, but locating a minor break of structure would also help. And we can see that, price was making its way down, but didn't actually create a solidified low until this point right here. That was a solidified low because then price started correctively moving in the opposite direction. Created a solidified high and then broke from there. So this would be a minor break of structure right here. So given that information, jump back to the 1 hour time frame. We can tell that although the extreme order block is often the safest, in this scenario, it didn't actually do anything. So this point of interest right here actually caused a minor break in structure. I'm going to mark that on with an arrow. I'm not going to label it MBOS just because I don't want things to get too clustered here, but I'm going to leave that arrow there. So we know that this point of interest is within premium pricing, so that checks one off the list. We know that it's the point of origin for the break of structure. Although this is the extreme up here, this caused a minor break of structure as well as the overall break of structure, so that adds validity to this point of interest as well. Now, identifying resting liquidity. In this scenario, there really isn't much liquidity. Let me drop down to the 15-minute again. Yeah, not really any clear area of liquidity here. You could argue that, you could place a trend line here as liquidity, and of course that would be broken. But yeah, in this scenario, there isn't clear liquidity. But as long as we're looking for it, that's, there's something to be said about that, right? So we're aware that there isn't any clear spots, but that doesn't mean that there's not a trading opportunity available. So because of this minor break of structure and the overall break of structure, the market structure in general here is very clear to me. So there is a trading opportunity. So I would be interested in taking this trade. Of course, if there were clear imbalance and clear resting liquidity, I would be even more interested. Maybe in a situation like this, you could risk a little bit less. So instead of 1% total risk, you could do 0.5% or even 0.25% because we're sort of missing two of these steps, right? So step number 5 is do not over refine the point of interest. Remember, the goal is to find a winning trade, not to have the tightest stop loss possible. So let's set up a position tool here and see what kind of parameters we can get. Okay, so this stop loss is a little bit bigger. Remember, this is just a trading example. We're on the 1 hour time frame. I typically don't enter from the 1 hour time frame, but this is still a great example. Now to target for profit, we're going to go for the recent structural low right here. Just this low right here. And that would achieve just over 7.3R. So that's a very healthy position. keep in mind in this scenario, because we're missing two of these steps, imbalance and resting liquidity, we may want to risk less, but the point remains that there is still a valid trading opportunity here. So let's play price forward and see what happens. Okay, it looks like we're going to need some more room. Okay, well, good timing on that stop. So we were just triggered in. Let's play price forward and see how this reacts. Now, keep in mind, as you can see here, throughout this corrective movement here, we invalidated this point of interest, invalidated this, invalidated everything up until we got to here and mitigated. Now, keep in mind, this could, of course, still be a loss. We could push right through this stop loss and trigger this extreme point of interest anyways, right? Like, this strategy is not 100% correct, but it is a significant edge on the market. Let's continue this trade. Okay, wow, that was quick. So yeah, that was very quick. So of course on lower time frames, we'd see multiple minor breaks of structure within here, but inevitably price reached the full take profit for 7.34R. So this was just another example of a risk entry where you can go through these 5 steps to validate your point of interest and to locate, well, first of all, to locate the highest probability point of interest, and then to further validate that point of interest. Okay, so I hope you guys enjoyed this example. Now we're going to move on to a couple examples of confirmation entries using these exact same 5 steps. All right, guys, now to take a look at a confirmation entry example using these exact same 5 steps, we're currently on USD JPY on the 1 hour time frame. So as you can see, I've already marked out a 1 hour point of interest, which was also found using these same 5 steps. But as we all know, for a confirmation entry, we need the higher time frame mitigation and lower time frame execution. So price is already tapped into this 1 hour point of interest. Now what we're going to do is drop to the lower time frame. In this example, I'm going to use the 5 minute for more confirmation in terms of structural breaks to add validity to our trading bias here. So we're looking for long positions, of course, because this is a demand area. Now, what we need to do now is wait for, we're going to play price forward and wait for confirmation in terms of market structure. Okay, we already have some. So let me pull this back a little bit. So we've tapped into the 1 hour point of interest. We traded away from it, created a high, a solidified high, then created a low, which was relative equal lows. We never surpassed that low, so it looks like bullish momentum is in control. We clearly have a break of structure here, so that is step 1, of course. Let me just mark that on. All right, so we've already taken care of step 1, locate the break of structure, a clear break of structure with candle bodies, not wicks. So very clearly we have that right in front of us. Now, second would be gauge premium versus discount pricing. So we're going to bust out the Fibonacci tool once more. I'm going to drag it from this wick low right here to this high right here. Actually, you know what? I'm going to play price forward a little bit more because I don't know that that's a solidified high. So let's wait for, there we go. So let's wait for price to turn around. Okay, so right about there, I can say comfortably that that's a solidified high because price is starting to trade in the opposite direction. So I'm going to drag the Fibonacci tool from this low to this high. And by doing that, we can clearly see that we can ignore anything to do above the 50% line. So we're targeting a buying position, so that means we need to be looking at price action below the 50% line. So that leaves us with a couple options here. Let me delete this tool to clean things up. So like I said, we have a couple options. 2 points of interest that I can clearly identify. One right here. And another one right here, which would be considered the extreme. Okay, so right off the bat, we can eliminate one of them using the third step in our list over here. So we can eliminate the extreme for one simple reason. Between the 2 points of interest, one of them clearly created impulsive imbalance, right? As we can see, after this point of interest was printed right here, we had a strong bullish momentum, which created imbalance here, more imbalance here, right? So that was a very strong level. And prior to this point of interest, all of this price action was very balanced, okay? It was very efficient. All the wicks were touching. There was no disruption in price. So this is the point of interest I'm going to be looking at. Now, technically, if you wanted to trade from this, you could place your stop loss below this low here anyways, just to be safe in case your analysis was incorrect. But I'm feeling pretty confident that this would be a good area to target. So I'm going to drag that out and place a buy position here. Let's see what we can do with the stop loss. So just below that low would be 7.5 as a stop loss. I don't feel like that's necessary. Typically on the lower time frames, we can refine it quite a bit more. So let's see. You could probably get away with 5 pips, but that's a little tight. I'm going to go with 5.5 pips as a stop loss. And let's see, let me jump back to the 15-minute time frame. Yeah, as for targets, I'm going to target the most recent structural high. I don't see anything that would stop price from getting there. So let's drag that out and see what that provides us. So that's a nice 7R position. Okay, let's drop back down to the 5-minute time frame and see if this trade plays out. So as you can see in the typical confirmation model, we have the higher time frame point of interest that has been mitigated, and now we have a lower time frame structural confirmation, and now we're ready to execute. So this point of interest was found by using all of these steps, right? We did not over refine, that's for sure. We didn't get down to the extreme. It didn't make sense to do that. We didn't even drop down to the 3-minute or the 1-minute time frame because it wasn't necessary to do so. I was able to get a comfortable stop loss without dropping down any further. I don't need to get a 2 to 3 pip stop loss. I'm not trying to impress anybody. I simply want to get into a profitable trade. So 5.5 pips as a stop loss is more than enough for me. In terms of step 4, identifying resting liquidity, right away we can see that there is resting liquidity right here in the form of relative equal lows, which could be looked at by retail traders as a double bottom. So we know that there's going to be resting liquidity there, which adds validity to our trading idea here, our point of interest here. We know that price purges liquidity, so it's more than likely going to trade lower. We're not going to see a reversal from here. We're going to trade lower, most likely mitigate our point of interest, and then trade higher from that point on, hopefully. So let's see what happens. All right, so as you can see, this was a valid level of liquidity too. We did react to this low briefly, traded away from it a little bit, but then inevitably purged that liquidity and clearly mitigated our point of interest here. So what I'm going to do is move over the position tool to show that we have been entered in this position. Now let's play price forward and see if this trade works out in our favor. All right, so clear profit right away. Nothing much else to go over just yet, but it is clearly working in our favor. There is another minor break of structure here, so technically you could move the stop loss to break even right below this low or slightly in profit. Okay, it came back down. This would have actually been a scale-in opportunity right here, but that's not the point of this video. Okay, looks like we're going to need some more room. All right, so big impulsive movement here. Big impulsive movement that clearly broke structure. So this position is looking quite healthy. Let's see if we get the full take profit. And we do, okay. So as you can see, this was an example of a confirmation entry based on the 5 steps of choosing the best point of interest. So we found our higher time frame point of interest, which was the 1 hour time frame, also using these 5 steps, right? And then we scaled down to the 5-minute time frame for our lower time frame confirmation. We waited for a break of structure. We waited for resting liquidity to form in the form of double bottoms, a double bottom or relative equal lows. We located the best point of interest within this fractal market structure based on the fact that this point of interest here was in discount pricing and we're looking for a buying position. So we only want to be buying in discount, not premium. So we also identified that this point of interest caused impulsive imbalance, whereas the extreme point of interest did not do such things. So this was the highest probability area to trade from. And that's exactly what we did. We'd set a limit order here based on this confirmation structure. And we inevitably reached a 7R profit. So I hope you guys enjoyed that example as well. Now let's go over another one. Okay, everyone. So in the last example of this video for a confirmation entry, we're going to do something a little bit different. So I'm hoping this example opens your eyes to a little bit of also how confirmation entries can be utilized, because they are very versatile. It's a very versatile model. So we're currently on Euro USD on the 1 hour time frame. And as you can see, I've marked out 2 points of interest. This is going to be our higher time frame, the 1 hour. Okay. So I've marked out 2 points of interest here. We're looking for a buying position because we have clear bullish order flow and this massive impulsive bullish move that has been since filled. But this was the point of interest that was targeted on the higher time frame, again, using these 5 steps. And this one here is just the most recent supply zone that I think I'd like to target for profit if we can get into a trade here. So disregard this supply zone for now. But in terms of the demand zone, we've already tapped in. We've definitely triggered 50% of the demand zone too, so we can certainly confirm this as mitigated. So either price is going to react to it or push right through it and bearish order flow will take control. So the reason this example is a little bit different than others is that our lower time frame here for confirmation structure is actually going to be the 15-minute time frame. Now the reason this is important is because a lot of people have a misconception that a confirmation entry needs to be executed on the 1-minute time frame. That is 100% not true. All that matters is that there's higher time frame mitigation and lower time frame confirmation and execution. Okay, so the 1 hour is our higher time frame in this case. So technically anything lower than the 1 hour time frame could be used as confirmation. You could go to the 30-minute, the 15-minute, the 5-minute, it doesn't matter, as long as we have confirmation for our bias. So that means not entering right off the point of interest on the higher time frame and hoping that it holds, but going to a lower time frame or even just slightly lower and waiting for confirmation structure. So in this case, let's go to the 15-minute time frame. And what I'm going to do here is wait for confirmation structure. So we've tapped into the point of interest. Let's play price forward. As of now, I would be looking for this high to be broken to trigger my long bias and seek an entry for a long position. So let's see if we can violate that structure. All right, so right here is where it happens. So this is also a flip zone too, because this right here was our level of supply. Price tapped into it, traded away from it briefly, so it was respecting supply, and then it flipped into demand because it eventually violated the supply. So keep in mind, we're still on the 15-minute time frame. Now, a couple things here. Locate the break of structure. This is clearly the break of structure. That's step 1, right? Gauge premium versus discount pricing. This part is very subjective, okay? Because we are on the higher time frame. So technically you could drag the Fibonacci or Ganbox tool from here to here. And in that case, it would certainly look like we're in premium discount and shouldn't be buying. However, if we were to analyze this price action on the lower time frames, we would actually be in severely discounted pricing, because I'm looking at it as this being the bearish leg, okay? The reason being, everything here was extremely efficient pricing, We had no imbalances. There was a slight imbalance here, but it was filled. So everything was consolidating, and everything up until this point here, supply was still in control. It was from this flip zone that we created a new bullish leg. So this is our solidified low. This is our solidified high. If we were to drop down on the 5 minute, for example, we would see that more clearly. This is the bullish leg that I want to be targeting. This is where the momentum kicked into the market. This is what was responsible for breaking market structure. Okay, so that's the point here. Gauging premium versus discount. It depends on the trade idea that you have. You have to be very careful analyzing price action. If you're just swing trading on the higher time frames, 4 hour, 1 hour, etc., it's much easier to gauge premium versus discount. But if your goal is to be a day trader, if you're trying to intraday trade, then you need to gain experience on the fractal nature of the market and be able to analyze premium versus discount on lower time frames. So with that being said, we're going to drag the Fibonacci tool from this low to this high, and we can clearly see that we have an obvious point of interest within discount pricing. Now, there's a couple ways to look at this, right? If you wanted to be safer, you could just target this entire demand, the entire zone that was consolidating prior to the bullish break of structure. You could target that as your entry. That's not my style, really. I would prefer to refine it a bit more than that. So what I'm going to do is actually target this candle right here. That was the last low momentum point of demand prior to the bullish break of structure. Now, this is not over refining. It does look quite refined from this time frame, but like I've said in the previous examples, over refining to me would be going down to the 1 minute or the 30 second or the 15 second and trying to obtain a 1 pip stop loss or something like that. That to me is over refining. And remember, the goal is to find a winning trade, not to have the tightest stop loss possible, right? This isn't about ego. This is about making money. So this is my point of interest. I'm going to drag it out here. And I'm going to go ahead and set a buy limit with the entry parameter tool. Stop loss. Let's make it an even 5 pips. And what that does is clear this low here just to be safe. Now, if we go back to the 1 hour time frame, right, we can clearly see the supply zone, the higher time frame supply zone that I've marked out here. And that's going to be what I'd like to target for profit for multiple reasons, but overall, just the higher time frame perspective, it makes sense that this area would be mitigated and that price would be bullish until then. So that's going to be the entry parameters for this trade. That leaves us with a potential 16R opportunity. So fantastic trading opportunity. And I really hope this example showcases the confirmation entry model, because like I said, all that matters is that we're on a lower time frame from our anchor time frame. Our anchor time frame is the 1 hour, and we're on the 15 minute, which is much lower, of course. So it doesn't matter which time frame you use for structural confirmation, as long as there is structural confirmation. So like I said, instead of just placing an entry limit on the higher time frame POI and hoping that it holds, what we did is waited for price to react, mitigate the 1 hour POI, and then trade away from it. And then the confirmation here was that we reacted to supply, traded away from it, and flipped into demand. So this right here is what shows me that bullish order flow is now going to take control, or at least it should, right? We could always be wrong, but this is better confirmation. This right here is better confirmation than simply entering off the higher time frame POI. Okay, so let's go, let's stay on the 15-minute time frame for now and see if this trade gets triggered. Let me just adjust the chart here. I want to get a better perspective. Okay, so we're also now getting into tip number 4, identifying resting liquidity around the point of interest. Okay, so this is our point of interest right here, of course, and we have significant resting liquidity right here. Retail traders may be looking at this as a bull flag, right? This is a bull flag that most retail traders are familiar with. So plenty of stop losses resting below this level. Most retail traders are not looking for things like this, so their stop losses are right about here. That represents liquidity. The market is going to be drawn to this area like a magnet to purge the liquidity from here and mitigate this area here before hopefully taking off in the correct direction. Or not the correct direction, but the anticipated direction. So let's play price forward and we'll see what happens. Okay, so we get tapped in. To be honest, the point of interest was violated a little bit. As you can see, that wick did pierce just below my rectangle tool right here. That's no big deal. Clearly it's been respected still. Oops. Clearly it's still been respected. And that's why I always place a stop loss just below. Again, there's no ego involved here. I'm not trying to get the smallest stop loss possible. If I were to go that tight to my zone with a 3-pip stop loss, then I would have been stopped out and missed this opportunity. But being safe and covering the other wicks here, I'm able to stay in the trade and clearly achieve significant profit. Because keep in mind, on the 15-minute time frame, there's a lot within here that we can't see. We'd have to go down to the 3-minute or the 1-minute to see everything that's in here. So this point of interest is valid on the 15-minute time frame, but on the lower time frames, I may have been targeting something down here, which would have achieved a more refined entry and a different stop loss placement. But that's irrelevant. This is the point of interest that we're targeting. Our stop loss was safe enough to stay in the trade, and we are significantly well in profit. Now we have another break of structure here that could represent another buying opportunity for this POI here, which is of course in discount pricing. If you're looking at this bullish leg, it's the discounted pricing of that bullish leg, but we're just going to stay in this initial position. Let's play price forward and see how this one pans out. Okay, we're going to need some more room. Almost tapped into this order block here, this point of interest. Not quite, just a few pips away it looks like. Definitely going to need some more room. Just going to drag everything out. Okay, there you have it. So the full take profit was eventually hit for 16R. And I really hope this showcased how the confirmation entry can be utilized using these 5 steps. So this was a very profitable trade, and we've now gone over 4 examples of how to utilize these 5 steps to choose your best point of interest. We've gone over 2 risk entries and now 2 confirmation entries. The reason I wanted to do that is to appeal to any style of trader, because we all have different preferences. Me personally, I actually jump between the 2 confirmation and risk entry styles quite often. It just depends on how my week is going, how my schedule in my personal life is going. I don't always have time to wait for confirmation, so I'll oftentimes utilize lower risk and go for a risk entry. So I really hope you guys enjoyed this video. I think there was a lot of value within this video. Provided multiple examples of how you can choose your best point of interest utilizing these 5 very simple steps. And I really hope you all apply this to your own trading and see some good results from it. So with that being said, hope you all enjoyed this, and I'll talk to you all soon.